Welcome back to Raggedy Ass Rich, where we keep it real about money and wealth building. I'm your host, and today we're talking about something that affects your entire financial life, but nobody really explains properly. Credit scores, what they are, why they matter, and how to actually improve yours without falling for scams. Let's get into it. All right, so let's start with the basics because a lot of people don't actually understand what a credit score is. Your credit score is basically a number that tells lenders how risky it is to lend you money. It ranges from 300 to 850. 300 to 579, poor. 580 to 669, fair. 670 to 739, good. 740 to 799, very good. 800 to 850, excellent. And here's what most people don't realize. This number affects everything. It affects whether you can rent an apartment, whether you can buy a car, whether you can get a mortgage, what interest rates you pay, whether you can get a credit card, sometimes even whether you can get a job. So yeah, it matters. Now let's talk about what actually affects your credit score. There are 5 main factors. 1. Payment history. This is the biggest factor. Do you pay your bills on time? That's what this measures. Every time you miss a payment, your score drops. Every time you pay on time, your score improves. So, if you want to improve your credit, the number one thing you can do is pay your bills on time. Every single time. Set up auto pay if you have to. Set reminders, whatever it takes. Because this is 35% off your score. 2. Credit utilization. This is how much of your available credit you are using. Let's say you have a credit card with a $1,000 limit. If you're carrying a $900 balance, you're using 90% off your credit. That's bad for your score. The rule of thumb, keep your utilization under 30%. Ideally under 10%. So if your limit is $1,000, try keep your balance under $300. Better yet, under $100. How to do this? Pay off your balance multiple times a month, not just once. Request a credit limit increase, but don't spend more. Spread purchases across multiple cards if you have them. But here's the key. Don't just move that around. Actually pay it off. 3. Length of credit history. This is how long you've had credit. The longer your credit history, the better. This is why financial experts tell you not to close old credit cards, even if you're not using them. Keep them open, because closing them shortens your average credit history. If you have a credit card you've had for 10 years, keep it. Put a small recurring charge on it, like Netflix. Set it to auto pay and let it sit. That old account is helping your score just by existing. 4. Credit mix. This is the variety of credit types you have. Credit cards, car loans, student loans, mortgages, these are all different types of credit. Having a mix shows you can handle different types of debt responsibly. But here's the thing, don't take out a loan just to improve your credit mix. That's not worth it. This is only 10% off your score. It's not worth going into debt for. 5. New credit inquiries. Every time you apply for credit, it creates a hard inquiry on your report. Too many hard inquiries in a short time hurts your score because it looks like you are desperate for credit. So don't apply for a bunch of credit cards at once. Don't apply for loans you don't need. Be strategic about when you apply for credit. Now let's bust some myths because there's a lot of misinformation out there. Myth number 1, checking your credit score hurts it. False. When you check your own credit, that's a soft inquiry. It does not affect your score. So check your credit regularly. You can check for free at annualcreditreport.com. You can also use Credit Karma, Credit Sesame, or your bank's credit monitoring. Check it, know what's on there. Myth number 2, you only have one credit score. False. You actually have multiple credit scores. There are 3 major credit bureaus: Equifax, Experian, TransUnion. Each one calculates your score slightly differently, so you might have different scores from each bureau. And on top of that, there are different scoring models: FICO scores, Vantage score, different versions. The point is, don't obsess over the exact number. Focus on the range you are in and the trend. Is it going up or down? That's what matters. Myth number 3, closing a credit card improves your score. Usually false. Closing a credit card can actually hurt your score because it reduces your available credit, increases utilization. It shortens your credit history. So, unless the card has an annual fee you can't afford, keep it open. Myth number 4, carrying a balance helps your credit score. Absolutely false. This is one of the biggest myths. People think they need to carry a balance to build credit. No. You do not need to carry a balance. You do not need to pay interest to build credit. Pay off your balance in full every month. That's how you build credit without wasting money on interest. Alright, so how do you actually improve your credit score? Here's the step-by-step. Step 1, check your credit report. Get your free report from annualcreditreport.com. Look for errors, accounts that aren't yours, payments marked late that were actually on time, accounts that should be closed but aren't. Dispute any errors you find. This alone can boost your score. Step 2, pay all bills on time. Set up auto pay. Set calendar reminders, whatever it takes. If you have past due accounts, catch them up. Even one late payment can stay on your report for 7 years. Step 3. Pay down your balances. Focus on cards with the highest utilization first. If you can, pay more than the minimum. Pay multiple times a month if possible. Get those balances down. Step 4. Don't close old accounts. Even if you're not using them, keep them open. Put a small charge on them every few months so they stay active. Set it to auto pay. Step 5. Limit new credit applications. Only apply for credit you actually need. And if you're shopping for a loan, like a mortgage or car loan, do it within a 14 to 45 day window. Multiple inquiries for the same type of loan within that window usually count as one inquiry. Step 6. Become an authorized user. If you have a family member with good credit, ask if they'll add you as an authorized user on their card. Their good payment history can help your score. Just make sure they pay on time, they have low utilization, they are responsible. If they miss payments, it hurts your score too, so choose carefully. Step 7. Consider a secured credit card. If your credit is bad or non-existent, a secured card can help you build it. A secured card requires a deposit, usually $200 to $500. That deposit becomes your credit limit. You use it like a regular credit card, pay it off every month. After 6 to 12 months of on-time payments, your score improves. And many companies will graduate you to an unsecured card and give you your deposit back. Now let's talk about what not to do. Mistake number 1, paying for credit repair services. Most of these are scams. They charge you $500 to $1,000 to do things you can do yourself for free. Disputing errors, you can do that. Negotiating with creditors, you can do that. Creating a payment plan, you can do that. If you need help, go to a nonprofit credit counseling agency. Look for agencies accredited by the NFCC, the National Foundation for Credit Counseling. They offer free or low-cost help. Mistake number 2, ignoring collections. If you have accounts in collections, don't just ignore them. They won't go away. They'll stay on your credit report for 7 years. Instead, contact the collection agency, negotiate a payment plan or settlement. Get everything in writing. Make sure they report it as paid or settled. Yes, it'll still show on your report, but paid collection looks better than unpaid collection. Mistake number 3, maxing out your cards. Even if you pay them off every month, maxing them out hurts your utilization ratio. Credit bureaus don't know you're going to pay it off. They just see you're using 100% of your credit. So keep your balances low throughout the month. Now, the question everyone wants to know: how long does it take to improve your credit score? The truth is, it depends. If you just have a few late payments and high balances, you could see improvement in 3 to 6 months. If you have collections, charge-offs, or bankruptcies, it could take 1 to 2 years to see significant improvement. But here's what I want you to understand. Improving your credit is a marathon, not a sprint. You're not going to go from 500 to 750 in a month, but you can go from 500 to 750 over time with consistent effort. Every on-time payment helps. Every dollar you pay down helps. Every month that passes without new negative marks helps. It's slow, but it works. Now, I need to say something. The credit score system is unfair. It punishes poor people. If you're struggling to pay bills, you miss payments, your score drops. Now you can't get credit, or you get credit with terrible interest rates, which makes it even harder to get ahead. It's a cycle, and the system is designed this way. So if your credit score is bad right now, I need you to know it's not entirely your fault. The system is rigged. But that doesn't mean you can't improve your situation. But you just have to play the game. Learn the rules, work within the system, and slowly build your score up. It's not fair, but it's reality. Alright, let's wrap this up. Your credit score matters a lot. It affects whether you can rent, buy a car, get a mortgage, and even get a job. The 5 factors that affect it: payment history, 35%, credit utilization, 30%, length of credit history, 15%, credit mix, 10%, new inquiries, 10%. To improve your score, check your report for errors, pay all bills on time, pay down your balances, keep old accounts open, limit new credit applications, and avoid credit repair scams, ignoring collections, maxing out your cards. It takes time, but it's possible. And once you have good credit, protect it. Keep paying on time, keep your balances low, because good credit opens doors, and you deserve to have those doors open. That's it for today's episode of Raggedy Ass Rich. If you found this helpful, share it with someone who's trying to improve their credit. Next episode, we're talking about insurance, what you actually need, and what's a waste of money. Until then, keep building, keep learning, and remember, your credit score doesn't define you, but it does affect your options. So take control of it. Peace.